Alex. Welcome to Nexus Deep Dive. Today, we're dissecting the intricate and rapidly evolving landscape of cryptocurrency, moving beyond the headlines to uncover the profound shifts currently underway. What began as a niche technological curiosity has matured into a multifaceted domain, presenting both transformative financial innovation and considerable speculative turbulence. We observe not a singular trend, but a confluence of forces shaping its present and charting its future. One of the most captivating and, frankly, controversial current trends we see is the explosive growth of prediction markets, often operating on blockchain rails. Platforms like Kalshi and Polymarket have surged into the mainstream, promising to gamify truth by allowing users to bet on real-world events, from political outcomes and economic indicators to sports results and even pop culture phenomena. What's truly striking is their increasing integration into traditional media, with prediction odds now appearing on major news channels and financial tools. The sheer volume of capital flowing through these platforms, reaching billions weekly, has attracted significant institutional interest, with entities like Intercontinental Exchange and Goldman Sachs exploring their potential. Proponents argue that these markets offer superior information aggregation, a wisdom of crowds that can outperform traditional polling or expert opinion, providing a unique lens into collective foresight. They envision a world where these markets could guide policy decisions or allow individuals to hedge against specific risks. However, the critical perspective cannot be ignored. Detractors, many rightfully so, label them as glorified gambling, raising concerns about market manipulation, insider trading, and the ethical implications of financializing every conceivable event. The Lord Miles saga, where a content creator allegedly bet against his own challenge, highlights the potential for abuse and the murky waters these platforms navigate. The regulatory environment remains a contentious battleground. The Commodity Futures Trading Commission, CFTC, views these as event contracts, a form of derivatives, while states and traditional gambling interests argue they fall under their jurisdiction as unlicensed gambling operations. The political winds play a significant role here. A more crypto-friendly administration, as we've seen under recent shifts, can accelerate their legitimacy and growth, even leading to advisory roles for prominent political figures. This regulatory dance, however, underscores a fundamental tension. How do we foster innovation in a nascent, high-risk space while protecting consumers and preventing systemic vulnerabilities? As Amanda Fisher, formerly of the SEC, astutely pointed out, everything that happened in GameStop is happening in crypto markets but on steroids, highlighting the speculative fervor and often less regulated nature that attracts retail investors seeking high-octane opportunities, far removed from traditional oversight. Parallel to this, we are witnessing a quiet, yet potentially revolutionary, institutional embrace of blockchain technology through the tokenization of real-world assets, RWA. WisdomTree's recent SEC approval for a tokenized money market fund represents a landmark moment. This isn't about speculation on volatile digital coins. It's about leveraging blockchain's inherent efficiencies to overhaul the very plumbing of traditional finance. The ability to trade shares of a money market fund 24/7 with instant settlement on blockchain rails fundamentally reimagines cash management, collateral mobility, and payment systems. The implications of this are profound. Imagine eliminating settlement risk and counterparty exposure that come with waiting days for trades to clear, leading to greater capital efficiency across the board. While the $25 billion tokenized RWA market is still a mere fraction of trillions in traditional funds, its growth signals a strategic shift among financial behemoths to integrate this technology. Visa, for instance, has already positioned itself as a leader in stablecoins, demonstrating how established players are finding ways to not just coexist, but to lead in the digital asset space. The SEC's willingness, particularly under a more pro-business administration, to grant such exemptive relief suggests a pragmatic recognition of blockchain's potential. As James Seifert, an ETF analyst, noted, this approval serves as a powerful proof of concept, signaling what's possible when innovation meets regulatory flexibility. It's an effort, as some suggest, to future-proof the industry against potential regulatory reversals by building a foundation for mainstream adoption. Yet, amidst these innovations, the broader crypto market continues to grapple with its inherent speculative nature and volatility, often driven by retail investor sentiment and meme-like phenomena. While institutional players meticulously build out RWA infrastructure, the headline narrative frequently swings from exuberant rallies to sharp corrections. The Great Rotation narrative, which recently noted crypto has crashed while other assets soared, serves as a stark reminder that digital assets, for many, remain a high-risk, high-reward proposition. The enduring legacy of the meme stock revolution cannot be overstated here. The retail investors who drove GameStop to dizzying heights have largely diversified their speculative appetites across various asset classes, with crypto being a prime beneficiary. The accessibility of trading platforms, the allure of quick gains, and the communal dynamics of online forums like Reddit contribute to an environment where price discovery can be significantly influenced by collective action, often detached from traditional fundamentals. Even GameStop itself, post-squeeze, strategically held Bitcoin on its balance sheet, a testament to the intermingling of these speculative forces. This continued retail-driven speculation, while injecting liquidity and fostering engagement, also means the crypto market remains susceptible to rapid shifts, highlighting the ongoing challenge of distinguishing between genuinely disruptive technology and fleeting market fads. Ultimately, the current trend on crypto is a mosaic of contrasts. It's a space where sophisticated institutional players are quietly laying the groundwork for a new financial infrastructure, while at the same time, a vibrant, often chaotic, retail community is pushing the boundaries of speculative investing through novel instruments like prediction markets. To recap our discussion, first, prediction markets are rapidly redefining how information is valued and monetized, creating both powerful new data sources and significant ethical and regulatory challenges concerning manipulation and the nature of truth. Second, asset tokenization, exemplified by WisdomTree's SEC approval, marks a pivotal institutional embrace of blockchain technology, promising to fundamentally streamline and enhance the efficiency of traditional financial systems through 24/7 instant settlement. And third, the persistent speculative nature of a significant portion of the crypto market, fueled by retail investor fervor and meme-like dynamics, continues to drive volatility and highlight the ongoing regulatory tightrope walk between fostering innovation and ensuring market integrity. Thank you for joining us on this Nexus deep dive. If you found this analysis valuable, please subscribe to the channel, and we welcome your thoughts and feedback in the comments below. See you in the next deep dive.